Welcome to Real Estate Mastermind Live radio show. I'm your host, Edward Brown, and my two co-hosts, Jay Tannenbaum and Seti Gershberg of Scottsdale Mortgage Investments, are not here today. But we do have a couple of special guests who I've worked with for many, many years. Real Estate Mastermind Live is for real estate investors who want to learn from industry experts. We'll show you how to raise more capital, close bigger deals, scale your own portfolio, and more. We're also planning on having a trivia question, so make sure that you listen in as you'll want to participate in that potential prize. Our phone number is 888-912-1190. You'll use that number to answer the trivia question, or you can just ask us a question and we'll answer it the following week. And today we're also going to be giving away, like we did before with a special contest, the Pro Note Calculator, which is worth $179. And we're going to give that to the third caller with the correct answer to the trivia question. All right.
All of those.
So, nice. Yeah, I know. It's great. Actually, it's really cool. They put together, Jay and Seti put together with their team, this very fancy real estate spreadsheet calculator where you can throw anything in there and it'll figure out rate of return. So it's actually a very nice little prize. Okay, then this is the free version that they're going to give it out free here, but it's ordinarily they would charge $179. So now in the studio with us, we have Mark Hanf and Phan of Pacific Private Money, who I have worked with for, gosh, many, many years now.
2010.
So, yeah, I know.
Wow,
Isn't that amazing? Yeah. So welcome, guys, to Real Estate Mastermind Live.
Hello. Great. So, hey, so this is great. I'm really happy, Edward, to have the opportunity to speak to your audience today. And, given that this is a show for real estate investors, one of the things we can talk about is, we're in the business of raising capital at Pacific Private Money to make loans to real estate investors. In fact, I tell people all the time lately, because of the bank crisis, right? And people are saying, oh, how's it affecting your business? And, are you guys in trouble? And it's like, no, we are in a very unique niche area of lending as well as investing, where we make loans to real estate entrepreneurs. And there is no such thing as a bad real estate market for a real estate entrepreneur. It doesn't matter, real estate prices could be going up, going down. Right now, they're going down in many markets, but not all. But we still have a situation where there's a lack of inventory for homes. And so we see a strong demand from real estate entrepreneurs who are coming to us because they went to their bank and their bank said, yeah, we're not really lending right now. We're holding off on new loan originations until this bank crisis, they don't usually call it that word, but they'll say until the situation settles a bit, which banks are funny. Ever since Dodd-Frank, banking has gotten harder and harder and harder. And when, lenders like us, and we used to be called hard money, we prefer the term, private money real estate lender, but we used to be the lender of last resort 20 years ago, right? And we all remember that. In fact, I worked for a development company in the 80s and 90s, and every now and again, as a last resort, we'd go to the hard money guy if we couldn't get the bank money for one reason or another. But more often than not, we're the lender of first resort now. And Dodd-Frank actually legitimized the private money lending industry throughout America, and most of the companies today, the legitimate ones, the ones that are doing volume, are really an asset and a partner to real estate entrepreneurs to help them execute their real estate strategies. And so at Pacific Private Money Fund, we actually have 4 different funds that we have. And why 4? Well, each fund focuses on a different niche in the lending industry. Some are for ground up, others are commercial bridge. We have a consumer bridge fund, and we also buy notes, performing and non-performing. So it's an interesting time right now to be in lending, and in our industry, our phone's ringing off the hook right now.
I would think that with what happened with Signature Bank and Silicon Valley Bank, 2 things are going to happen that are actually going to be beneficial for your company, Pacific Private Money. One is, just as you saw with Dodd-Frank, where banks were a little, they were more challenged, let's put it that way, to make loans. now I think what's going to end up happening is there's going to be even more regulation put upon these banks. And so when that happens, people are going to have to go to alternative financing, which is specific private money. But in addition, from an investor standpoint, because you raise money from the public for investment, although people may be a little, let's say their eyebrows kind of raise a little bit and say, okay, well, let me make sure that this is okay. Your loans are secured by real estate. And, the interesting thing is that even though the bank, FDIC insurance came in, there was still kind of this, run on the bank, or just a concern that I'm not going to get my money out of a bank. So it's like, well, then what do? You have to look for alternative sources. And you guys pay a lot higher than what the banks pay. And it's not like you have people pounding on the door, as a run on the bank type of situation.
Yeah, we pay 7, 8, 9, even 10% to our investors for the use of their capital. So again, I know this is generally geared toward the real estate investor crowd and how to make money in real estate or how to raise capital in real estate. But this is also for people out there that maybe a real estate investor and maybe you sold at the top of the market or recently, and you're sitting on cash and you want to wait out the market a little bit. Maybe you believe home prices or real estate prices. We just talked to a guy today who's in the office space in San Francisco, and he's saying that resale prices for commercial properties are cratering right now in that market, right? Not all markets, of course, but so if you're looking to, you want to kind of keep your powder relatively dry, but you don't want it earning zero in the bank, we have a fund, the Pacific Freedom Fund, where we have no enforced and no penalty for lockup. We don't enforce the 12-month lockup like many private placements do, but we will pay 7, 8, or 9%, depending on how much money you're willing to deposit, and we'll, with a 30-day notice, we can cash you out. And so that's been really popular with real estate investors who just sold a piece of property or a business or what have you, or they have capital that they're just waiting for that opportunity to come up, but they'd like to earn some money on it.
Well, also I've been looking in the paper, and bank CDs, some of them have hit even as high as 5%, but you got to tie your money up for usually at least a year.
Yeah, 12 to 18 months.
12 to 18 months. And a lot of investors, even though the 5% doesn't sound too bad, it's still well below inflation, that they're still negative there. They don't really want to tie their money up because, again, they may find that other opportunity. Plus, the thing is, your Pacific private money funds qualify for some tax advantages that bank CDs don't. So
that's a good point. Yeah, that's a good point. And so we do get inquiries like, hey, I just saw, CD rate of 5%.
Yeah.
That's, how, and the Pacific Private Money Fund, maybe it's not paying quite, what it was before, but it's paying, 6.5%, 7%. That isn't a big difference, but to your point, there can be tax advantages with investing in a fund. And also at this point, most of our investors have been in the fund for over a year. Or in the case of the Freedom Fund, like Mark was saying, you can redeem your investment typically within 30 days. So much more liquidity and flexibility there versus something like a CD.
Yeah. And then we've got a newer fund. We've actually got 2 funds right now that pay north of 10% on an annual basis. Now those do have a 12-month lockup, but again, if you're looking to maximize, maybe you're frustrated with looking for opportunities to place your capital, you can, but you want to maximize your return and you like a 10% return, 10 to 11%. We can help you with that. We have a couple of funds that do ground up construction on residential real estate, and that's very popular right now, particularly since SB 9 was passed in California that allowed owners of buildable lots to do a lot split and put up to 2 homes each. So now you've got a lot that you could put 4 homes on. And I know a lot of people are taking advantage of that, and we're funding those projects, and that's helping add housing stock to California, which sorely needs that. So again, there's just a lot of ways that you can deploy capital nowadays into managed funds like ours at Pacific Private Money and earn a healthy return on that capital.
And let's get into your Freedom Fund for a minute. Generally, what is the goal of that fund? What kind of loans go in there, and how do you provide the liquidity?
Yeah, I can jump in here real quick with respect to the Freedom Fund. So the Freedom Fund for us acts as a sort of warehouse line, a quasi-warehouse line. Essentially, it allows us to fund loans, and we would hold them on the balance sheet or in the Freedom Fund for a short period of time. The reason is we have loan buyers, trading partners that like these loans that we're originating, and we sell them to them. So the difference between like the Freedom Fund and some of our other funds is that, the other funds we're holding them on our balance sheet or portfolioing these loans usually to maturity, where the Freedom Fund, we're only holding these loans on our books for anywhere from 10 days to a couple of weeks, maybe 30 days. But the intent is to fund loans in the Freedom Fund that we plan to sell to institutional loan buyers. So again, it has sort of warehouse-like functions for us or benefits, and it allows us to fund way more loans than we would otherwise if we had to hold it on our books.
Right. So some of our funds are portfolio lending funds, like the fund that Pacific Southwest Fund, for example, is our note buying fund. We buy existing notes at discounts, and we pay a fixed rate of 8% to our investors for deposits as low as $50,000. The Freedom Fund, the more you invest, the higher your yield, up to 9% on your deposits. And that money is generally to fund loans that we intend to sell. And there are a lot of note buyers out there. So that's a pretty vibrant business right there. And then the 10% money that we can offer is through funds that generally make construction loans that we hold in our portfolio. We manage the draws. We underwrite them. We're very conservative with those. We work only with experienced developers. So it's not the risky development loans from 20 years ago, which a lot of fund investors in the mid 2000s got stuck in some of those funds that were overzealous in their speculative lending to land developers. So we're not lending to land developers. We're lending to build ready, permit ready, small home projects, small subdivisions, relatively small multi-house. When I say small, it's between $1 million and say up to 10 million, right? And that's and again, we have two funds that focus on that type of lending. So it's just really we've designed our company in different divisions, and each division focuses on a different niche area, as I said at the beginning, of real estate lending and real estate investing.
And the best part, if I understand it correctly, is no investors ever lost money with you.
Nope. We've got a great track record over 15 years. No losses of investor capital. That's really, really important. And we've got a great crew. Our total crew size now is up to 50. That includes our staff, our underwriters, our processors, our LOs, our accounting staff. We do our own in-house loan servicing. We do our own in-house construction loan draws and draw management. So it's it's a serious business, and we're part of a handful. We're probably in the top 5% of companies based in California that do alternative real estate finance, and we've grown that to be that size thanks to over 300 investors that have invested with us. Currently, I think probably closer to 400 total over the last 15 years, and it's a great way to make money in real estate without actually owning real estate, and that's investing in real estate debt. Regardless of where you think the market's going with respect to real estate prices or residential home prices, or what's happening in office space or retail, lending conservatively on real estate, it's a much different ballgame. It's got safety and security features that you don't necessarily have if you're investing directly in real estate.
Yeah, that's what I've always liked about the debt side of things, is that you're in a deal for 60 or 70 cents on the dollar, so that if anything goes topsy-turvy and you end up with the property, you're not in it at 100 cents on the dollar. Now if you have a loan where the borrower is just paying like clockwork, then yeah, you're giving up some of the potential upside, but you're getting a decent rate of return, and you don't have the headaches. You don't get those calls in the middle of the night. Hey, the toilet overflowed.
Yeah. And on top of that too, we make, generally we're making short-term loans. So 18 months, or less. Our bridge loans in particular on average, and bridge loans for consumers, somebody who wants to buy their next home before they've sold their current home, they're usually in and out of our loan within 6 months or so.
Well, and that's interesting, because one of the problems with like Silicon Valley Bank was the fact that they had all this money and they bought really long-term bonds. And then when people needed their money back, they had to, that's actually one of the problems, is that the bank is not allowed to say, sorry, we bought 30-year bonds. You have to wait 30 years for your money, Mr. Depositor. I mean, they have to pay them right away. But your loans are so short-term that you guys generally are not getting caught up in the interest rate risk environment. You're just kind of going with the flow.
No, we're very reactive to rates. We were quick to raise our rates to borrowers when interest rates went up last spring and summer. They've leveled off a little bit. Hard money rates traditionally at least in California, because that's historically where we've spent our entire career, and we still lend mostly in California today. But prime plus 5, I know it's been higher in other states, as high as prime plus 8%. California's always had the most competitive hard money rates, and prime plus 5 was, like I said, was typical. At least that was our pricing 10 years ago. Today, though, it's prime plus 5, prime's 8, so that would be 13%. Well, we're not lending 13% money in California.
Yeah.
We may find that it trends up that way, but we're still lending in the 10s and 11s right now.
Yeah.
So if you're a real estate entrepreneur and you're thinking, well, hard money is expensive. Well, first of all, compared to what? Right? Compared to what? If you can't get bank money at 6 or 7 or 8%, it doesn't matter that it's cheaper than what we're quoting you. But it's less expensive today. When you're talking maybe 300 to 400 basis points over bank financing or over prime, that's there's still a lot of room in there for smart entrepreneurs to make money.
Well, especially those consumer bridge loans, there's no prepayment penalty. So, people can, maybe they get a little bit of a sting on paying, 300 basis points over prime, but they get the deal done, and then they can pay you off when they get a real bank loan.
Right.
Well, you mentioned consumer bridge. So that's something that we do at Pacific Private Money that's a little bit unique in the industry. Most hard money lenders won't touch anything that is consumer purpose, meaning if you're a potential home buyer because you want or need to move and you don't want to sell your home first, or you're in a market where you're still competing with cash buyers, and let's face it, 30% of real estate nationwide is still being purchased cash. Cash is still king in real estate acquisition, right? So if you're a home buyer and you want to move, we have a consumer bridge loan product that, as long as you have sufficient equity in your existing home, your departing residence, we could do a loan to you for up to 100% of the property that you want to buy. In other words, we can do 100% financing on your target property if you have enough equity in your home, because we'll cross-collateralize that loan. We'll make one loan to help you buy that home, and we'll secure it by the new home and your existing home, as long as you have enough equity, where we solve for about a 75% combined loan to value. And you can move right in. You don't have to move twice. You don't have to put your stuff in storage. You don't have to try to sell your home with you still living in it. And when done correctly, you're going to make more money on the sale of your old home, because now you've moved out. You and your realtor can go back in and freshen it up, maybe stage it, paint, whatever, you're going to sell it for more money. You're going to make 5 to 15% more than you would have gotten had you not done that. And that extra profits help pay for the cost of the bridge loan. So there's a lot of ways to use, hard money or private money today smartly that, isn't as obvious unless you understand that, money's a tool, and used correctly, you can execute some pretty amazing real estate strategies for yourself.
Okay.
If I can add to that too, regarding bridge loans, I just read an article today about how boomers now outnumber millennials for real estate activity. So the population of boomers who need to move is actually grown larger than millennials. And a lot of that are going to be really downsizing boomers who are, empty nesters. A huge number, significant number own their homes free and clear.
Mm-hmm.
And that's interesting, because the fact that a lot of people refinanced at really low rates.
Mm-hmm.
So depending upon how much equity they have when they sell their property, if they, if they don't have to take on a lot of debt at a higher interest rate, that'll be a compelling reason to go ahead and move.
Right.
Otherwise, there's going to still be a lot of inventory not being put out there, because your average person has a normal 60 or 70% LTV loan,
Mm-hmm.
and if they've purchased, or if they've refinanced a few years ago when interest rates are really low, that's going to be hard for them to swallow, selling that house and then getting a new loan when they had, let's say, 2 or 3%, and now they're going to come in at 6% with the bank. Right.
No, and what you're describing there, I think, applies more to millennials who've either, purchased in the last few years or refied. They have potentially these handcuffs, like this low interest rate handcuffs that are going to maybe not compel them to move just yet. But boomers who own their homes free and clear, who don't have a mortgage, or if they do, it's a really small amount.
Mm-hmm.
But because of life circumstances, they sort of have to move, because they, it's a 2-story house, and they really can't go up those stairs every day.
No, but they'll have once they cash out, they'll be able to pay all cash.
Absolutely.
For the property. But here's the other thing I was just going to add to that, the fact that, like you said, some of these millennials, let's say, whatever, have these handcuffs on about moving, that should help keep prices somewhat stable, because you're not going to have a lot of inventory just flooding the market, right?
Right. Yeah.
Well, it's interesting, before interest rates spiked, there was an article in New York Times blaming boomers for the lack of inventory of existing houses. Now, that has nothing to do with new house production. That's a factor of home builders for reasons including difficulty of obtaining permits. But we're just not building new homes at a pace to keep pace with growth and demand. But there's been a dependence on the existing home market inventory and people moving up and moving down. But as you pointed out, a lot of boomers have small loans or no loans, but they still feel trapped because they don't want to sell first, and they don't have the cash necessarily handy for a down payment with a bank loan, or the bank might tell them, because you're on a fixed income, we're not going to be able to, until you sell your existing home, we're not going to be able to make you a loan for your new home. So what a lot of people don't know is that, and this is kind of a dirty little secret in real estate and mortgage financing, but once you live in the house, it's actually easier to get bank financing on that home than it is to get a purchase money loan from a bank. And that's, and that's head scratching for people, right? It's like, it can take, well, first of all, try going into a contract with a 45 or 60 day loan contingency, because oftentimes, depending on your circumstances, it might take you 45, 60. I mean, in my case, it took me 90 days to refinance my mortgage down to an existing lower rate a few years ago. Why? Because I'm self-employed. So there's just all kinds of reasons why you want to be able to use a bridge loan like what we provide to capture that property, to get title of that property, to move in it. Now you've got it. Now the banks, you take as long as you need, and it's just harder to get that 21 or 30-day purchase money financing in a lot of situations. So it's the bridge loan helps free up inventory, is what we like to say. And for anybody listening that's a real estate professional, you need to understand how bridge loans really work, because you can increase your commission income by promoting bridge loans to clients that you've identified as who want to move and need to move, have to move, and you can help them. You can be a hero to that client, and you earn commissions from those transactions.
All right, so there's the people who should call you, and we'll give out your information in just a second here. Yeah. Realtors who want to make the commissions to buy and sell for their clients. Then there's going to be the just borrowers by themselves who are listening and saying, you know, I don't know if I can get a bank loan. And then also that would entail mortgage brokers who would work with you. And then lastly would be potential investors who want to earn anywhere from 7 to 9+%. Why don't you give out your information, and then we're going to cut to a break.
Sure. If they want to reach us by phone, they can give us a call at 415-883-2150. Or they can reach us at www.pacificprivatemoney.com.
All right.
Call in, ask for us.
Okay, we're going to cut to our commercial break here. And again, the special trivia contest, the third caller with correct answer is going to win the Pro Note Calculator, which is worth $179. Here's the trivia question. I'm talking literature here. What book written in 1954 is about schoolboys on an uninhabited island which has characters such as Jack and Piggy? What was the name of that book? I had to read that when I was in 10th grade. I still remember it. Okay, call 888-912-1190. The third caller with the correct answer is going to win the Pro Note Calculator, which is really basically it's a spreadsheet, but it's easy to use, which is worth $179. Again, here's the trivia question. What book written in 1954 is about schoolboys on an uninhabited island, which has characters such as Jack and Piggy? All right, stay with us. Real Estate Mastermind Live. We'll be right back. Welcome back to Real Estate Mastermind Live radio show. I'm Edward Brown, your host, along with my special guest, Mark Hanf of Pacific Private Money. Our trivia question, here it is. In 1954, the book written then about schoolboys. In fact, if I remember correctly, it was a plane crash on an uninhabited island, which has characters such as Jack and Piggy. Do you remember that book?
Did it have pictures?
I'm not sure.
I only read books with pictures.
Yeah, that's right. That's the only ones I like. Lord of the Flies. Lord of the Flies.
That's right. No, actually, I never read that one, but
I had to read that one. It was anything other than Harold and the Purple Crayon. It was a tough one for me. And as I said, I 6 years of high school twice.
That's
okay.
Right.
All right. So, Mark, you're president of Pacific Private Money, and you raise money for your funds. But even before you had the funds, you were allowing investors to basically pick off onesies and twosies, individual deeds of trust, and you're kind of going back. I mean, it's sort of like a smorgasbord, whatever people desire. Why don't you talk a little bit about the differences between them?
Sure. Well, let's set the table a little bit. So Pacific Private Money is an alternative real estate finance company, which is a very complicated way to say we're hard money lenders or private money lenders. California, the term hard money was kind of ditched maybe 10 years ago or so. But when I say hard money, it's pretty descriptive. People know what I mean. We're an alternative source of financing for real estate entrepreneurs, for real estate investors. And we've been in business for 15 years. We started I started lending in 2007 and started the company in 2008. So I was lending into a market that was, I don't want to say it was too dissimilar to this because it was similar. I don't think the market we're in right now, which in many markets is trending downward in terms of residential real estate values, and people are looking and waiting for opportunities to pounce on. There were certainly a lot of opportunities in 2008, 9, and 10, and we were making short-term bridge loans to real estate entrepreneurs back then. We did so very successfully. We never lost any of our investor capital on loans that we made to real estate investors who were, at that point, buying, fixing, and flipping foreclosure real estate largely, or distressed property. But more than that, my background, I'm a 40-year real estate professional. I was in real estate development for the first 20 years of my career until 2006, when everything went kind of upside down. 2006, 7, and 8, a lot of real estate development companies didn't survive. I was part of a company that did not. And I ended up pivoting into hard money lending because I knew a lot of people who had money and they loved investing in individual notes secured by real estate at 65 to 70% loan to value approximately. To people who had an exit strategy, they had a business model. They were looking to, buy real estate that they could improve and then flip and sell or keep and refinance. So, when we say we make bridge loans, what we mean are, it's a bridge, either, a short-term bridge loan, or it's a bridge to an exit strategy. And usually there's really only two exit strategies. You're either going to sell the property that we loan you money on to purchase, or you're going to refinance it. So we basically are in the business of renting capital. And again, to mostly real estate entrepreneurs, as opposed to hard money of 20 years ago, which is generally considered the lender of last resort. In most cases today in 2023, we're the lender of first resort. We're the lender. In fact, how many real estate investors do you know, Edward, today that can go and depend on a bank to provide financing for a real estate deal they've got that they absolutely positively need to close at the end of the month?
Oh, no, even if they didn't need to close right away, it's still hard to find. But from a timing standpoint, if you need the money fast, zero. You have to go to alternative financing.
Yeah. And today, ever since Dodd-Frank, it's gotten harder to get bank financing. And I always tell people, look, if you can get a bank to give you a construction loan or a fix and flip loan or a line of credit against real estate you own, and then you've got access, you've got control of that capital, absolutely do that. But, now we're in a so-called banking crisis where banks have now pulled back quite a bit. In fact, I know we're getting calls from contractors and developers who are saying, hey, my bank just said, hey, I'm sorry, but we've put all our new financing commitments on hold until this thing fleshes out. Well, bad news for banks or bad news for the economy is generally good news for lenders like us. And we like making loans to real estate entrepreneurs because we are real estate entrepreneurs, and we know that there's no such thing as a bad real estate market when you're a real estate entrepreneur. When you're an investor, a flipper, you're looking for opportunity. We look for disaster and find the silver lining, right? That's what we do.
Well, especially with the fact that you're doing short-term loans, it's generally going to be hard to be in a bad market, because even when real estate declines, it doesn't fall off a cliff overnight. Right. And so even in, let's say, 2008, 9, and 10, when Pacific Private Money was lending money to borrowers, maybe the real estate went down in value, but you were out of those loans.
Right. If I were making 3-year loans in 2008, I would have lost a lot of investor capital. Right.
Maybe.
Maybe, right. Yeah. But it would have been more likely than the loans I was making, where they were buying, fixing, and flipping real estate within 6 to 12 months.
Yeah.
And maybe they weren't selling it for quite as high as they had thought they were, because real estate prices were trending downward. But, we still successfully financed a lot of projects there. But Edward, you started in the beginning of the show, talking about the investment side of our company. So we serve 2 clients at Pacific Private Money. All of our capital comes from private individuals who invest with our company or through our company, either in one of our funds that we use to make loans through, or by buying individual notes, investing in an individual note, also called trust deed investing, right? Yep. So We work with trust deed investors. We work with investors who would prefer not to compete for trust deeds, but would rather invest in a fund, for example. So that's the source of capital. And then, of course, our borrower clients, we wouldn't exist if there wasn't a demand for capital from real estate investors and entrepreneurs. And so we serve both. And so if you're a real estate investor and you need capital, you come to a company like ours. Now, not so much today, but I want to say back in 2008, 9, and 10, real estate prices are going down, foreclosures are happening, and real estate entrepreneurs are buying homes. I remember, I can't tell you how many hundreds of people were saying, we're buying homes at 65 cents on the dollar. Can you give us 100% financing? Because you loan 65% loan to value. And it was like, well, no. Maybe you're getting it for 65 cents on the dollar. If you are, great, but we still need you to have some skin in the game. And
we'll lend you 65% of the 65%.
Generally speaking, which today is more like 70. I mean, some lenders have pulled back to 65 again. Some have even pulled back to 60 because, again, there's, different companies out there who do lending. They're all small businesses. They're all run by, the owner or the team of people there, and they have to make decisions on, will we do 75%? Will we do 70% loan to value or loan to purchase price? Will we do 60 or 65? We're generally still lending at around 70%, even sometimes 75. It really depends on, the metrics of the deal.
Sure.
We're very much a subjective lender, as are most people in our industry. And what I mean by that is you come to us with a loan proposal, and what we're going to look at is not just the asset, although you will find some lenders are purely asset-based lenders. They don't care. They hope you have a pulse, but they don't really, at the end of the day, they're just looking at the real estate and they're lending on the real estate. And if you don't do what you say you're going to do, they're going to foreclose on you, no questions asked. Then there are lenders like us who we look at not only the asset, but we're looking at you, your experience, your capacity. Do you have a good credit score? That's always helpful. You got cash in the bank, so, what's your skin in the game? Do you have investors? Do you have equity investors that you're working with that provide you the capital slice of that real estate opportunity you're looking to do? So we look at that, and it sounds complicated, but it's not. We actually can ask you a series of questions and literally within minutes, give you a green light, yellow light, or red light. Now, that doesn't mean, you can go to the bank and get your check or go to the escrow company, but it's still a relatively quick process. It's still, it could be a week. It's generally 2 to 3 weeks. Just because
a lot of it's going to depend on the escrow company, how fast they can do the title insurance. And
I mean, we don't like fire drills. We prefer people not call us up and say, hey, I got a deal, but it's got to close in 72 hours. Those can be quite expensive. We're going to charge you a lot more points and fees on something like that because, your emergency now becomes our emergency, which means we got to push other deals out of the way and a fire drill for you, which we've done, and we've done it many times. And again, that's where we provide value. When you absolutely positively need the money, we can accommodate that oftentimes in certain situations. So one of the other things I wanted to mention, Edward, is when you're that I don't get this as much as I used to when foreclosures were in their heyday, but I used to get a lot of questions or calls from my borrowers who, once they learned that, we required them to have some skin in the game, they'd go, well, can you introduce me, or can I get the names and contact information of some of your investors? Because maybe they would be interested in being an equity investor with us. And, I had to defer and just say no. And there were a lot of reasons why I said no. The biggest reason was, I have a relationship with them and you don't, and I don't really know you. So for me to say, hey, there's this guy and he says he really knows what he's doing, and maybe you should consider, putting up $100,000 for
well,
the equity.
it's back to the guy the borrower not having his skin in the game, and
Right.
he's just working for you or working for your
Well,
client.
you could still, but you're right. But there's still a lot of people have made a lot of money in real estate with never having any of their own money in, zero money down, right? That's still possible. You can raise equity by from private individual investors. And I actually ended up writing a very short book. It was only like 70 pages long, The Insider's Guide to Attracting Private Money. It's still available on Amazon, The Insider's Guide to Attracting Private Money. And I wrote it for my real estate investor clients saying, here is a very short and to the point number of exercises that you can do and you should do to create a credibility package on you and your real estate strategy. And with that, you can go to various industry events that are happening all over, the country and particularly California. There's a lot of real estate investment groups, and there are people there that will go there with money, and they are looking to make, outsized returns. Now, for example, people who invest in one of our funds or one of our trustees generally receive anywhere from 7 to 10%, depending on the deal, on their money. Well, there are people who like investing in real estate related activities, but they want to make more than that. So if you're a real estate entrepreneur and you're looking to find your own access to private money, you would create a credibility package on yourself, which includes things like, your strategy, your budget, your exit plan, and other things about the strategy, your strategy for success. And with that, you go out and you meet people and have a conversation, create a relationship with them. I know it's and really all this can literally happen in one meeting. But generally speaking, it takes a little bit of time, but it's well worth the investment. And so you can get private money from individuals that you meet and create a relationship with, who want to JV with you, joint venture, on buying, investing, and either flipping or holding real estate. And then you come to a private money lender to get the debt side of the equation. So again, you can do it with no money out of your own pocket if you have the right combination of experience, success, track record, and the ability to sell yourself, basically, in so many words. So it's
what's the name of the book again that they can get on Amazon?
The Insider's Guide to Attracting Private Money. Very short read, worth the investment. I talk about the 5 steps to money method. I won't get into the detail of that now because I'm not really trying to pitch the book. I mean, I wrote it like 5-6 years ago, and I give it away to clients. Anybody that comes visits me, they never leave without one of my books saying, hey, just, it's a quick read it. It'll give you some ideas about.
I did actually read it, and actually there was a lot of good information in it.
It is. Again, you got to give to get. And that was information I felt very comfortable giving away because, again, I want people to come back. I want to help people succeed in real estate investing. And one of the best ways to do it is to get educated, find capital partners that you can trust and who trust you, and then come to companies like Pacific Private Money for the debt side of it. Because generally speaking, in real estate, you can do all cash deals in real estate, but you get better returns. You generate better returns for you and your capital partners with the judicious and smart use of capital. And you have to define for yourself what that is. Do you get the most do you get the most leverage possible? Or do you, are you conservative? Do you go for 50%? Do you go for 80%? It's really, it's really up to you.
Interesting. Well, let's get to talking back to the investment side. So again, people can invest with you in your funds. You also have individual deeds of trust because there's some people who just don't want to invest in a fund. They want to be in control of exactly which asset they're buying, they're investing in. and you're also having a webinar coming up here. I think it's April 12th, if I'm not mistaken.
You had to, my team is setting that up, and I'm sorry.
That's okay. But you know what? Let's give out Nam's email, and then they can bombard him with the question of, "Hey, when's that webinar?"
Right. Yeah. For more information about our next webinar, send an email to Nam. That's N like Nancy, M like Mary at pacificprivatemoney.com. He's the one who's putting that together. I feel like kind of silly not knowing whether it's for sure April 12th, but we'll all be there, whatever day.
Well, here's the other thing too, is
whatever
that
day it is.
People can also send emails to Nob if they're interested in seeing like the individual deeds of trust that you guys are offering to individual investors, because the rates are above 9%, if I'm not mistaken.
And no, it's really easy to get a hold of us. Just go to our website, pacificprivatemoney.com, pacificprivatemoney.com. There's a whole bunch of tabs. We have content, we have podcasts, we've got videos, we have our family of funds that if you're looking at maybe investing in real estate debt, that's what that's the type of investment strategy for the capital that we raise from our investors. We offer real estate debt as a strategy to make 7, 8, 9, 10% on your money reliably, with safety and security features that you don't find in many, more so-called traditional investments like stocks or other types of investments. So yeah, we have 4 different funds right now that we offer for investment, and there's 4 different ones because each of them has a slightly different strategy for how it makes money for its investors. Our most conservative fund is called our Pacific Southwest Fund. That invests in notes that we buy at discounts. And it's our most conservative because the weighted average loan to value in that fund is less than 50%, but we're still paying 8% returns for deposits starting at $50,000 and up. And then our Freedom Fund, which is a fund that we do not enforce, or I should say there's no penalty for early withdrawal. Therefore, we tell people to give us a 30-day notice and we can get you your money back. So it's a way to park your funds that you would prefer to keep relatively liquid. If you're one of those that at least likes to keep your powder dry, but you don't want to earn nothing on your money while it's sitting there. For deposits above 1 million, we will pay you 9%. With monthly distributions. So it's a pretty cool, deal. We have a lot of real estate investors who've sold real estate and park it in the Pacific Freedom Fund and earn 9% on their money while they go out and look for their next opportunity. And then if 10% or higher floats your boat, we got a couple of options there. We have both our North Star Fund and our Pacific Opportunity Fund. Both of those focus on ground up construction on residential, as well as some small commercial loans as well. And that one is our most aggressive fund for investors for whom a return of 10% or higher is of interest and attractive to them. So just a lot of different ways, in addition to investing in individual notes, which, as you said, Edward, can make you as much as, somewhere in the 9% range. The difference is with a fund, you are diversified, right? And your risk is spread across all of the loans in the fund. If you invest in an individual note, then you have a deed of trust on that one property, and that you're reliant on that borrower to pay you. And so there's a little bit, the risk profile is a little bit different for individual deeds of trust. But as you mentioned, that a lot of investors, that's what they prefer. They want to be the bank. They want their name on the note and deed of trust. They want to have that foreclosure power. And it's funny because one of my longest investors at 15 years now, all of his real estate that he owns, he got by making a private loan, individual deed of trust with his name on it that he ultimately had to foreclose on. So I don't, I won't comment on the the political or social aspect of loaning to own, because I don't come from that camp. Although I do own real estate.
And it
that I've had to
depends. I mean,
foreclose on.
sometimes sometimes it's actually a friendly foreclosure, where the borrower just says, here's the keys. I just can't get out from underneath this.
Yeah, they call that a deed in lieu of foreclosure, and I've done that. There are risks to it because if there are any unknown liens, your safest way is to actually go through the 4-month foreclosure process. That way you wipe out any liens behind you. But there's a way you can do a title search and see that there's nothing behind you, and then you're taking the chance that someone doesn't come out of the woodwork and make a claim against you. But deed in lieu of foreclosure you're right. That's a way to also make loans to
or just a friendly foreclosure,
or
right?
friendly foreclosure.
Just says, hey, I'd love to pay you, but there's just not enough equity in there for me at this point. There's a bunch of different reasons. Again, why don't you give out your information one more time? This would be for people who either want to borrow money, want to invest money, or want to come to the webinar.
That's right. That's pacificprivatemoney.com, pacificprivatemoney.com, or call us anytime. We're in the 415. We're at 415-883-2150. That's 883-2150, 883-2150. And we'd love to hear from you, and we'd love to answer questions.
And you have a real brick and mortar building that you run the office out of.
We are not a virtual company, no.
Yeah, exactly.
Although we do have some remote workers, but
Sure.
we've got at any given day, we've got 10 to 15 people in our office in downtown Novato, which is in North Marin in the Bay Area. We're actually in a former bank building, formerly occupied by a bank that no longer exists.
Yeah. You're in the financial district block.
That's right. I'm looking out my window right now. Wells Fargo and Bank of America are right across the street from me, and Chase is one door up. So yeah, the financial district of downtown Novato. Free parking.
Yeah, that's right. You probably have to give them some more business cards because they're going to probably end up turning people away and saying, you know what, you better go see Pacific Private Money for loans. We're not going to be able to help you.
Wouldn't be the first time. Yeah.
No,
it won't be the last.
No, some of your best referrals come from banks.
From banks and mortgage brokers who say, hey, I can't help you, but call these guys. They may be able to do something for you.
Yeah. So again, from the audience standpoint, the best part is to date, no investor has ever lost money, and you've done billions of dollars if you add them all up of loans.
Over $2 billion in fundings across close to 3,000 loans, close to 400 investors have worked with Pacific Private Money. So big numbers. I mean, last year alone, we did $500 million in new loan originations, our best year ever. So we've got 15 years of growth, and it's a thriving industry, alternative real estate finance.
All right, Mark Hanf from Pacific Private Money. Thank you for joining us here on Real Estate Mastermind Live radio show. Next week, we'll have our regular co-host, Jay Tannenbaum and Seti Gershberg of Scottsdale Mortgage Investments. We're going to cut to our thoughts for the day. So George Bernard Shaw said, both optimists and pessimists contribute to society. The optimist invents the airplane, the pessimist, the parachute. And how excited was the gardener about spring? So excited he wet his plants. Tune in next week to Real Estate Mastermind Live. We're going to be discussing various aspects of real estate and asking more trivia questions. Thanks for listening. On behalf of our team, I'm your host, Edward Brown. We'll see you next week. So long.
Nice.
Thank you, sir.
All right.
Okay.
Real good.